There has never been a greater time than now to invest in the Metro Detroit area, and there is no other investment firm better qualified than Platinum Real Estate Holdings. With 40 years experience and over 1,000 homes sold, let Platinum Real Estate Holdings assist you with the purchase of a city-certified home of the highest quality, turnkey properties, screen renters, yielding instant cash flow. Well, what are you waiting for? Call or visit us online today. Welcome to the weekly recap for the week of May 2nd. In today's recap, we're going to tell you the top U.S. cities with the most and least residential vacancies, share a home price index that will give you unique market insight, and lastly, help you wisely choose the right real estate market to invest in. And we would like your feedback. This week's recap begins now. First, we go to the 5 U.S. cities with the most and least residential vacancies. Some areas of the country are growing exponentially faster than others. There are some cities that have for rent signs up almost continuously. Other cities where there isn't time to put a sign in the ground and the property is already rented. The information comes from a study done by RealtyTrack, where they took publicly recorded real estate data and compared it with monthly updated vacancy data from the U.S. Postal Service to come up with the following cities. Only metropolitan areas with at least 100,000 residential properties were included in the rankings. Here we go. The 5 most vacant residential cities are as follows. Number 5, Atlantic City, New Jersey, with 3.7% residential vacancies. Number 4 is Beaumont, Texas, with 3.8% vacant residential homes. Number 3 is Youngstown, Ohio, with a 4.4% vacancy rate. The last 2 may be no surprise for some. According to RealtyTrack, the number 2 city for the most vacancies is Detroit, Michigan, which has 5.3% residential homes vacant, which equates to more than 80,000 homes, 13% of which are bank-owned homes. And the number 1 city by percentage for the most vacant residential homes, drumroll please, the city of Flint, Michigan, with 7.5% home vacancies, which equates to 11,605 homes. 87% of the vacant homes are investment properties, which means people don't want to rent the homes and the landlords are not getting paid. Now for a list of the most hard-to-get cities to buy residential property because of the lack of vacancies. Each one of these cities are under 0.5% when it comes to vacancies. The number 5 city is Lancaster, Pennsylvania, with a 0.3% vacancy rate. Number 4 is Provo, Utah, also with a 0.3% vacancy rate. Number 3 is Manchester, New Hampshire, again with only a 0.3% vacancy rate. The number 2 city is Fort Collins, Colorado, boasting a 0.2% vacancy rate. And the number 1 city with the least residential vacancies should really be no surprise to anyone. It's San Jose, California. This is the home of Google, Apple, Facebook, and all those other tech companies whose websites we use every day. They have only a 0.2% vacancy rate as well. Only 858 vacancies out of over 443,000 homes. Next, we are revealing a home price index that you may not be aware of that could provide you with unique market insight. It's called the FNC Residential Price Index. This insight can help you forecast future property values, which can have a big impact on your rental property purchase and selling decisions. Let's first look at what the experts say are the 3 ways to calculate metro home prices. Number 1 is the median price. This is the most common way home price increases are reported to the press, and is the way the National Association of Realtors reports home price appreciation and depreciation. The second way is by a repeat sales index. The specific name for this repeat sales index is the S&P Case-Shiller Home Price Index, which, by the way, is the second most common price calculation method. The Case-Shiller Home Price Index looks at individual homes that sold recently and compares the recent sale price to the sale price the last time the individual home sold. Then they run some statistical magic on all their current and past sales data to create their index. This index isn't in dollars and cents. However, an index makes it easier to compare appreciation and depreciation rates between cities. The third type and last is called hedonic price index. This is the least commonly seen home price index. In a hedonic analysis, they take all the information they have on homes, location, size, bedrooms, baths, etc., and run it through an algorithm to estimate the value of pretty much every single home in any area. From these individual home estimates, they estimate the value of the area as a whole. The Zillow Home Value Index is probably the most well-known hedonic index. A type of hedonic index we're going to talk about right now is one of the least used. It's called the FNC Residential Price Index. FNC Incorporated pioneered real estate collateral information technology. They sell this information to mortgage lenders and appraisal management companies. The good news about the FNC Residential Price Index is that it makes forecasts several months out so that you can see what their algorithm is thinking will happen to home prices. The FNC Index can provide very different results from the Case-Shiller Index. Maybe the biggest advantage of looking at the FNC Residential Price Index is that most people don't use it. You might glean insights into your local market that are counter to conventional wisdom. In the last segment of this recap, we're considering how we can know if any given real estate market is wise to invest in or not, especially if you're investing out of state. There are several times we find a property that has some great investment specs. You know, the investment price is right, and then you look at the market cap rate, the rate of return on a real estate investment property based on the income that the property is expected to generate, and that looks great too. The problem is, if you see a property with a very low price and a high rate of return, the caution flag should go up because typically there's a trade-off between the two, which means you have to ask more questions because the market may be very risky to invest in. Before I list out the things that can be impacted by market, let me explain very briefly the three types of markets out there. Number one are growth markets. The population is trending steadily upwards. Number two are stable markets. These markets aren't necessarily growing at a rapid rate, but they are steady enough where they are likely not to experience much decline either. And number three are declining markets, which means the population is trending steadily downwards. What causes the differences between the three types of markets, you ask? Simply put, jobs, industry, and general desirability. These three things just about cover it all. The next question you may be asking is, what can the direction of the market affect in terms of owning rental properties? Number one, it will affect your exit strategy. You may not be able to sell it when you're ready to. Number two, your rentability. Basically, it will impact your tenant pool down the road. If your property is in a growth market, you can expect a continuous pool of tenants. In a declining market, you should be concerned that your tenant pool will shrink. And number three, it'll affect your profit. The point of owning rental property is financial gain, right? And if your exit strategy and rentability are affected, they are both key factors in determining whether or not you end up profiting off a rental property. I know your last question would probably be, how do you know if a market is growing, declining, or stable? The answer is by doing your research on the general population trend. How many industries are present in the market? The job picture. Is the employment rate going up or down? And finally, general desirability. I know that sounds like a horribly generic thing to consider, but it says a lot. Why would we assume a market nobody really cares to live in is actually going to grow or increase that much? So there you go. Next time you're presented an out-of-state deal, look at everything going on behind the numbers, especially the market the property is located in. How about you? What are your favorite and least favorite markets for investing right now? For newbies out there, are there any markets you're considering investing in, but you're not sure it's right to do so? Leave your comments and maybe we can help. Well, that's this week's recap. If you have any comments or need any advice, please let us know in the comments below. Thanks for listening and have a great day. This has been your weekly real estate investment news recap. Did you find this recap helpful? Please like or comment below this video to enter to win a free copy of our ebook, The Ultimate Real Estate Guide for Residential Real Estate Investments. You can also subscribe to our channel or go to our website to receive the latest in real estate news. Our website also affords you the opportunity to view our latest turnkey properties.